For more than 35 years, Anton Tagliaferro has scanned company balance sheets, interviewed chief executives and studied company operations looking for investment opportunities. A funds management Hall of Famer, it's 25 years since he founded Investors Mutual. Well, he's shortly to retire, but not before we get him to work out the current state of the markets for us. Anton, as always, many thanks for your time. Right now we've got a situation. Interest rates are going up, bond markets are in some turmoil. But strangely enough, you see companies even this week. You saw Premier Investments, the retailer. You've seen Brickworks in the past couple of weeks have stellar results. They seem to almost fly in the face of what's happening on the stock market.
Well, of course, the stock market's forward-looking, and what Premier Investments and Brickworks are reporting is what's just been happening and what's currently happening now. And part of the issue is the economy is too strong, hence why those companies are having good results. And if you go out now, the restaurants are full, and you go, what's wrong? Everything's fine. Well, that's the problem. The problem is things have to slow, and central banks, London, the restaurants are full. Central banks are trying to slow the economy. They have to get demand down because inflation's too high.
OK, but hang on, but this almost flies in the face of it, because at the moment, while the restaurants are full, while people are building houses, they seem to be absorbing the interest rate rises for now because people have got jobs. Now, kind of you want that to be in a situation. You want people to have jobs. You want them to be spending. You want them to be prosperous. You want companies to be strong. Is there an argument here that maybe, that central banks are drinking all the Kool-Aid from the same bucket?
No, you don't want people to be spending too much. You don't want employment to be too strong because it's all inflationary. And the problem is at the moment there's an inflation problem. Now, where it's come from exactly, you can talk about supply strains, commodity prices going up, etc. One of the key sources, of course, wages are going up. The employment is tight. And when employment is tight, it means people spend, obviously, because they're very secure on their job. They can ask for wage rises. Etc. So the central banks, they don't have many tools, and interest rates, they say interest rates are a very blunt tool. You can either put them up or you can put them down. Now, putting them down is easy. Everyone enjoys the fruits of when rates are coming down, particularly when they go to zero and mortgage rates are 2%. But, of course, when they're going up, they're much more painful. And the truth is, and I think I said this when I was here months ago on the show, the problem is inflation is up there, 7, 8, 9 or 10%, and interest rates are 2 or 3%. So they're well behind the 8 ball. That's the issue. So, of course, people are spending because rates are still very low. Real rates are still -4, -5 in the real economy. Yeah. So people are still spending. And the issue is, OK, everyone's hoping for inflation to come down. Rates have to go up. The question is, how much can inflation fall now that wages are going up? And how much do interest rates have to go up to slow it all down?
So then take me to the investment markets, because in the last month or so, people who were trying to buy the dip, as they call it, when markets have come down, they go, right, this must be the time to go because the central banks can't keep raising interest rates too much. Well, as it turns out, they were wrong. Buying the dip is probably a good idea strategically because it's cheaper than it used to be. But this time around, it seems to be a fairly dangerous sort of a practice for people to try and follow.
Look, the truth is, Ross, nobody knows what's going to happen. Nobody knows what the outlook for 2023 is. I mean, the IMF came out the other day, downgraded world growth, but they're still talking about an expansion. Well, the truth is the US looks like it could go into recession, et cetera, et cetera. The truth is, depends on how high rates have to go, And I think up to a month ago, people were thinking, oh, no, the central banks are bluffing, right? They won't go that tough because it's been nice, easy money for the last 10, 15 years, right? And the central banks have come in and kind of rescued financial markets every time there was a dip. Well, this time, as I said, they have this problem called inflation. And they can't come in and bail you out unless the Bank of England has to sort of support the bonds and currency because it's collapsing, right? So that's the issue. So the inflation is the issue, and central banks can't bail you out. In fact, they've got to take the lollies back. They've got to take the lollies gave you, all those low interest rates. Yes. They've got to take it back.
So apart from leaving your money in the bank and trying to be very risk averse, is there anywhere that you can park your cash these days?
Look, Ross, the share market, obviously, if you take a long-term view, there's value beginning to appear. Obviously, you know, it's at times of gloom when value appears, right?
But do you reckon it's the right time to actually try and well, it's always the right time to find the value, but is it the right time to execute, given what's taken place with those buying?
Well, again, you average in. You don't have to rush in today or spend it all tomorrow or next week, right? You can average in. I mean, stocks are moving, obviously, they're very volatile.
Well, going back in your history, that was part of the philosophy when you helped to set up that perpetual industrial share fund,
and
right?
we're looking now, right? So, Ross, there are three issues now. Forget the market going up and down. There are three things to focus on, right? Number one is, for companies, their interest costs are going up. So this is a negative for earnings. So if you look at, for example, the REITs, which distribute 100% of their income, but they've got 30 or 40% debt. Well, that debt going up means they may have to cut their distributions in the next year or two.
Yes.
It's not a disaster.
So their valuations come down.
So it's not a disaster, but instead of getting a 6% yield, you might have to get 5.2, you know, because their rates are going up at a time because, you know, they have a bit of debt.
Yeah.
So that's number one. Number two, obviously, the high debt at some point will impact consumers. Consumers will stop spending. You know, the central banks are going to keep hitting on the head until those restaurants, those cab queues are a bit shorter, right?
OK, so final one for you. You and I are old enough to remember back to the 1990s recession. Unlisted property trusts, unlisted mortgage funds basically ended up freezing themselves because their valuations came down so far. They didn't have the cash to pay out their investors. Is now a time to be cautious of some of those styles of investments?
Yes, it is a time to be cautious on everything, Ross, because nobody knows what 2020... What we do know is rates are going up. What we do know is consumer spending will slow. The central banks will slow it. And how that impacts various companies and various, you know, unlisted trusts depends on how much debt they have, how much is their income, etc. So, yes, there is going to be more volatility. Some companies won't make it. I mean, we've seen a lot of builders going broke in the last 3 months, right? So some companies won't make these tough times, right? So we are going, you know, at the moment, as we're saying, the company's results are good, everything's fine, and that's half the issue. The problem is central banks have to slow demand to get inflation down. OK,
so if you were stacking a portfolio right now, where would you like to see it overweight and underweight,
right, so
given the history?
OK, let's take a simple example. Coles and JB Hi-Fi.
Right.
OK? Now, Coles, you know, food, people will still buy food, even in a recession.
Yes.
The valuation, OK, 20 times, not that cheap, but on the yield of almost 4, you know, it's all right. It's getting there. Now, will people go and buy from Aldi because things get that tough, or will they buy their home? We don't know about the demand side. JB Hi-Fi, on the other hand, is a very discretionary type of good, right?
Yes.
If things get really bad, JB Hi-Fi sales will drop potentially. You know, they'll slow quite significantly. So, you know, some companies will be impacted more by this slowdown than other companies.
So do you think it's a time to go to those where it's effectively staples that people have to buy?
We are picking things which are more secure. The incomes, things like Horizon, where the coal contracts are long-term, Coles at the right price, you know, those sort of companies, yes. At this stage, because Ampol is another one, you know, petrol, the people who always buy petrol, maybe the volumes drop a bit because people stop driving if they lose their job or whatever. That's happened in 1990, by the way. But, you know, again, the volumes don't move that much. At least the volumes are quite stable, right? Yes. So, yes, we would rather buy those at this stage because with the others, you know, the JB Hi-Fis, the Domino's Pizzas, the Harvey Normans, you know, nobody really knows how bad the consumer downturn is going to be. And that will all depend on how much further the RBA has to keep hitting that interest rate button.
I'll tell you what, always good to have a chat to you. Anton Tagliaferro from Investors Mutual. We're going to do this again very shortly. Thanks for your time.
I look forward to it. Thank you, Ross.
Anton Tagliaferro there.